Okay, this is Chapter 8, Accounting for Receivables. These are the four learning objectives. We're going to try to get through the first two in this little video. Explain how we recognize receivables, which is simple, and how we value receivables and dispose of them. That's a little more difficult. Let's see here. There we go. We recognize receivables whenever we either sell something, whenever at the point of sale, or we provide a service. When we've done that, we recognize the revenue and the receivable. A note receivable is a little different than an accounts receivable. It has a formal contract and usually entails paying interest to the lender, and usually for more than 30 days. You usually think of a note being at least 60 days or 90 days, or could be years. Accounts receivable you think of being 30 days up to possibly 60 days, and there are some rare occasions where you have a vendor, a customer that can wield a lot of power, and they can demand longer periods on that. Other receivables like interest receivable, loans to employees and officers, income taxes that are refundable, all those things are and will be in the bottom of the financial statements, and they're just not part of our business. They're things that we do that wouldn't be regular revenues. Like a bank would interest receivable, interest revenue would be part of their business, but for a construction company, interest revenue would probably not be a big part of their business. It wouldn't be normal trade for them. It would go into other receivables. All right, here's some just interesting note receivables as a percentage of assets. You can see that Intel doesn't sell a lot of stuff on credit, apparently. Ford Motor Company does. Again, service organizations recognize receivable when we perform the service on account, and a merchandiser when we at the point of sale. Whenever we've consummated the sale, that's when the receivable occurs. Jordache sells merchandise to Polo for $1,000, $210 and $30. That's a 2% discount if paid within 10 days. Net due in 30 days. The journal entry would be debit accounts receivable, credit sales revenue. There is another entry that we're not seeing here. That's the cost of goods sold entry, debit cost of goods sold, credit inventory. That this chapter kind of ignores that entry, so don't forget that it's there. On July the 5th, Polo returns the merchandise, or part of the merchandise, $100 of it. Here's the entry, debit sales return and allowances. That's a contra revenue account, credit accounts receivable. Now Polo only owes $900 of that original $1,000 that was billed. Remember, again here, there would always be, in a perpetual inventory system anyway, there would be the cost of goods sold entry. You would debit inventory and credit cost of goods sold for the return, for the not for the price, but for the cost of the goods that were returned. You receive payment. You would receive not $900, but 98% of $900. You would credit accounts receivable for the amount that's still owed. You would debit sales discounts, another contra revenue account, for a 2% of $900, and cash would get debited for the rest. This was an interesting fraud case where just lack of oversight, lack of segregation of duties just caused a big problem. And in this non-profit foundation, this one person was able to take $1.5 million, basically because she was given the run of handling cash and making the deposits and reconciling the statements, and she had a boss who really didn't check on her. Tough stuff. Okay, Wilton sold merchandise on account to Bates, $50,000, $315 net 45, so 3% if paid within 15 days, net due in 45. On May the 4th, they returned merchandise with a price of $2,000, and on the 14th, Wilton received a payment. Here you go. They got accounts receivable sales revenue is the first entry. The second one is a return. Sales return and allowances, accounts receivable. Remember, there's each of those would be 2 entries. You would have the cost of goods sold entry that goes with each one of those. And then finally, cash. You're going to credit accounts receivable for the whole $48,000 still owed. You're going to debit sales discounts for 3% of $48,000 or $1,440, and credit and debit cash for $46,560. Okay, accounts receivable is always a current asset, and it's listed or presented on the balance sheet at cash realizable value. That is the amount of cash you expect to realize or receive from collecting your receivables. If you have $1 million worth of receivables, you're not likely to collect $1 million. You're likely to collect, hopefully upwards of 90% of that, but some percentage of that is not ever going to be collected, and we have to recognize that. These uncollectible receivables are losses, and they go to an account that we call bad debt expense. And we do this. We don't record bad debt expense under generally accepted accounting principles. Whenever we recognize that we have to write off an account, we do it at the end of the period when we make our adjusting entries. We make an adjusting entry for the bad debt expense, and that is the only time bad debt expense is touched. It's one of those sleeping beauty accounts. It stays asleep until we wake it up at the end of the period to make our adjustment. 2 methods. The direct write-off method is undesirable, not something that can be used in a generally accepted accounting principle format statement, and it doesn't report receivables at the cash realizable value. The allowance method that we're going to talk about now, it matches revenues and expenses to the period in which the revenues were earned and the expense was incurred. If we sell something and then a year later we write off that account, when did the expense show up? When did we make that expense happen? Was it when we decided to write it off, or was it when we sold the item to begin with? Well, generally accepted accounting principles would say that when the revenue was generated by the sale, that's when we should have recognized the expense, but we don't know it, so we estimate it. We have an estimation process. Here is the Warden Company writing off Emmy Doran's company or balance for $200 under the direct write-off method. Anybody can do this. It is not according to GAAP. This is a bad example of how to do it. But you debit bad debt expense and credit accounts receivable. You'll see that on the quiz and you'll see it on the homework, but don't be fooled. This is not the way people do it. The allowance method. We create a new, we're going to introduce at least a new contra account. This is a contra asset account called allowance for doubtful accounts. You know that a contra asset account lives in the asset section of the balance sheet. It has a credit balance and it offsets some asset, and this one offsets accounts receivable. So accounts receivable would come first. The next account would be allowance for doubtful accounts, and the difference between those two would be the cash realizable value of accounts receivable. We during the adjusting process, we debit bad debt expense and credit allowance for doubtful accounts. And when we write off each account, we are going to debit the allowance for doubtful accounts and credit accounts receivable. What happens is this is a wash in the asset section of the balance sheet and affects no income statement accounts. All the income statement account happens in the adjusting entry, number 2 up here. In number 3, when we write off the account, we don't change anything in the on the balance sheets really, except just the amount of accounts receivable and the amount of the allowance. The cash realizable value hasn't changed. Let's say that this company has $1,200,000 in sales. Of of this amount, $200,000 is uncollected at the end of the year, so their accounts receivable balance is a debit of $200,000. The manager estimates that $12,000 will be uncollectible. The adjusting entry, by the way, this is the first year of operation, so we know there's no balance in the allowance for doubtful accounts account. So we're going to debit bad debt expense and credit allowance for doubtful accounts for $12,000. If there had been a balance, we might have had to, we would probably have had to look at that to decide what the adjusting entry should be, but we'll talk about that a little bit later. Anyway, this would be the only time we would touch bad debt expense, when we make our adjusting entry. When we write off an account, we would debit allowance for doubtful accounts and credit accounts receivable. Here's a presentation on the income, on the balance sheet. You can see it, accounts receivable, $200,000, allowance for doubtful accounts, $12,000. This $188 is the cash realizable value. It's also the net accounts receivable or net realizable value. If you write off an account, let's say here they write off a $500 account, it would be a debit to allowance for doubtful accounts and a credit to accounts receivable. But look at the cash realizable value. It doesn't change. We've written off a $500 balance, but the cash realizable value hasn't changed. It's going to stay the same. If somebody pays back an account that you had previously written off, in this case $500 a little bit later, we would we'd make two entries. The first entry reinstates the account, so we would debit accounts receivable, credit allowance for doubtful accounts for $500 in this case, and the second entry would be to recognize the receipt of the cash, and so you debit cash and then credit accounts receivable. Always two entries. This is kind of bunched up. I wish there was a little space here and a good description, but the first entry is to reinstate the account, debit accounts receivable, credit allowance for doubtful accounts, and then the second entry is to debit cash and credit accounts receivable. Seems cumbersome, but it's much clearer that way when you're looking at the books. Believe me. This is the disclosure statement that Nike made in one of their statements to tell people, to inform the readers of the statements how they value their accounts receivable, how they make their estimates of uncollectible accounts, etc. So these notes can be pretty lengthy sometimes. Okay, the percentage of receivable basis is one method of estimating our our uncollectible accounts. And under the percentage of receivables method, we actually compute what the balance should be in our allowance for doubtful accounts account. So this method calculates the balance in the account after the adjustment, and we have to back into the adjustment. I'll show you. Here we have an aging statement, an aging schedule for for this DART company, and it lists over here in the left all the total of all the receivables, and it lists those that are current, and then those that are 1 to 30 days past due, ones that are 31 to 60, 61 to 90, and over 90 days past due. Total up all the columns, and then underneath them we have the estimate of the percentage of each column that will be uncollectible. The current assets, current receivables, the ones that aren't past due, we usually collect about 98% of those, so 28% not collectible. We don't have to figure this out. The book will always give it to you. In real life, you get to figure it out. In the accounts that are 1 to 30 days past due, we usually don't collect about 4%. In accounts that are 31 to 60, about 10%. And finally, if it's over 90 days past due, we only collect about 60% of those, so 40% uncollectible. Multiply those out, and you come up with the amount that we expect not to collect from each of those categories. Total them up. This number is the balance after the adjustment in the allowance for doubtful accounts account. So let's assume we have an allowance for doubtful accounts credit balance of $528, and we want to end up with a credit balance of $2,228. That's a difference of $1,700. So we're going to debit bad debt expense and credit allowance for doubtful accounts for $1,700. My balance in that account will then be $2,228. Here's the adjustment. Unadjusted balance of $528, credit balance of $528, a credit adjustment of $1,700, ending balance of $2,228. That's what we came up with on our schedule, $2,228. So the percentage of receivables method, or the aging method, produces the balance that we want after the adjustment in the allowance for doubtful accounts. Assume differently that the allowance for doubtful accounts had a debit balance, and we wanted to end up with $2,228 after the adjustment. In this case, we'd have to make the adjusting entry would have to be more than the balance, because we have to overcome that $500 debit balance. I had to break off for a quick phone call, but assuming that there's a debit balance in the allowance for doubtful accounts account of $500, then the adjustment would have to be $500 plus $2,228 in this case. We'll get there. $2,728 debit to bad debt expense, credit to allowance for doubtful accounts. Remember, bad debt expense is never touched except during the adjusting process. And this is what the T account looks like, or the ledger looks like. You have an unadjusted balance of $500 debit with a you want to end up with $2,228, and so your adjustment has to be $2,728 to make that happen. The Brule Company has been in business for 5 years. Their accounts receivable is $30,000. Their sales revenue is $180,000, and the allowance for doubtful accounts is $2,000. They estimate that 10% of its accounts receivables are uncollectible. And this is a $2,000 debit balance, by the way. So 10% of receivables is $3,000. So we want a $3,000 balance, credit balance, in the allowance for doubtful accounts. So to overcome this $2,000 debit balance and get to $3,000 credit, we'd have to debit bad debt expense for $5,000 and credit allowance for doubtful accounts for $5,000 to get there. That would end up with a $3,000 balance, credit balance, and allowance for doubtful accounts, which is 10% of accounts receivable. Again, the aging method, or the percentage of receivables method, always calculates the balance after the adjustment, and you have to figure out what the adjustment is. Okay, disposing of accounts receivables. A company may sell receivables in order to get some cash in a quick fashion, or sometimes they just don't want to worry about collecting and all that stuff, so they just hand that off to somebody else by selling the accounts. Usually a finance company or bank, something called a factor is what they are. They buy receivables and then collect the payments themselves straight from the customers. They usually charge a fee of 1 to 3%, based on what they think the credit worthiness of the customers will be. Hendredon Furniture factors $600,000 of receivables to federal factors, charge of 2% of the receivables they purchase. The journal entry looks like this. You would debit cash for $588. It may be easier to do it this way. You're going to credit accounts receivable for $600,000 because those people don't owe you anymore; they owe somebody else. You're only going to get you're going to get charged a fee of 2% of $600,000, or $12,000. That's your service charge expense, and so cash would be the difference. In this case, $588,000. So debit cash $588,000, debit service charge expense $12,000, credit accounts receivable $600,000. Credit card sales. If you're using a credit card, if you're a company receiving or making sales using national credit cards, Visa, MasterCard, American Express, etc., you would debit the sale to cash less whatever the credit card issuer charges, 2 to 4% for its services. Here's a lady who purchases $1,000 of whatever from using her Visa card, the Visa charges, or this bank charges a 3% fee to the retailer. So it would be a credit to sales revenue of $1,000. The service charge is 3% of that. So debit service charge expense of $30, and then debit cash of $970. You haven't received the cash yet, but you will soon. You're going to record this as a cash sale. This is when it's a national credit card. You can read all this in the book. I'm going to go to something else. This company needs to raise $120,000 to cover next week's payroll. So it's reached its debt ceiling with its lenders. All this sounds like bad stuff to me. And so that its balance of outstanding receivables $750, and it decides to sell $125,000 of it, and pay a 1% service charge. So we would credit accounts receivable for $125,000. We would debit service charge expense for 1% of that, or $1,250, and we debit cash for the difference. Debit cash $123,750, debit service charge expense $1,250, credit accounts receivable $125,000. Okay, I think we're going to stop there. Going to look at a few problems. Here we are. These are just going to be reviews from previous chapters, most of them. I've got the little instructions out to the side of each entry, so we just go down to those. The first one, sold merchandise on account to Lawrence Company for $5,000, in terms 210 and 30. So a debit accounts receivable, credit sales revenue for $5,000. The cost entry is ignored in this chapter, so remember there's a cost of goods sold entry that you're not seeing here. Don't forget that guy is out there. Lawrence Company returned $700 worth of merchandise. Debit sales returns allowances, credit accounts receivable for $700. Again, this is a contra revenue account. Now they only owe us $4,300, and they pay within the terms of the discount. So we're going to credit accounts receivable for the amount they still owe, $4,300. We're going to debit sales discounts for 2% of that, or $86, and the difference will be a debit to cash. And Metcalf sold merchandise for $600. Oh, I want to mention again, on the third, this sales return would also have a cost element to it. You would debit inventory and credit cost of goods sold for the cost of this merchandise that was returned. And here we would have the same thing, the cost entry, but let's just but it's ignored. So it was sold on a Metcalf credit card, not a national credit card. Since Metcalf, the company that's selling this stuff, actually has to collect the money, you would debit accounts receivable, not sales revenue, not cash. So debit accounts receivable credit sales revenue, also debit cost of goods sold, credit inventory, but that's not in here. And when you add interest to those balances, you wouldn't debit interest receivable. That goes straight to accounts receivable in this case. So we debit accounts receivable and credit interest revenue for the monthly interest charge. The next problem we'll look at is the Fry Company sells merchandise to Hosfeld for $5,500, 210 and 30. Pays the amount due, and here's the entries. Simple entries. We've done it 1,000 times. Well, hundreds of times, maybe dozens of times, perhaps. I might have done it thousands. You guys may have done it dozens. Debit accounts receivable for $5,500. Credit sales revenue for $5,500. No returns or anything. So we're gonna when we make the collection in the terms, we would credit accounts receivable for the $5,500. Debit sales discount for 2% of that, or $110, and debit cash for the difference, $53.90. Again, simple entries that you guys have done several times before. And let's see here. This is going to be an interesting one. The Diddy Company shows accounts receivable of $180,000. Remember that. Sales revenue of $1,800,000 and sales returns and allowances of $60,000. So net sales would be $1,740,000. Remember those two numbers. Net sales of $1,700,000. Net credit sales of $1,740,000 and accounts receivable of $180,000. If they use the direct write-off method, journalize the entry on December 31st to write off Willie's account, $2,900. Debit bad debt expense, credit accounts receivable, $2,900. This is wrong. This is not good. I've put it over here in yellow. Don't use this method except as to show how not to do it. You'll have an entry like this probably on the quiz, probably on the homework. But don't forget that this is just showing how people do it who don't know how to do it. If the allowance for doubtful accounts has a credit balance of $4,300, here we are. We already have the little T account over here, and we want to journalize the adjusting entry on December 31st, assuming bad debts are expected to be 1% of sales. Now, in this case, we're not using the percentage of receivables. We're using the percentage of sales. And when we do percent of sales, what we calculate is the actual amount of the adjustment. So 1% of net sales, $1,740,000 times 0.01 gives me $17,400. So that's my adjustment. The balance is going to be what the balance is going to be. The balance ends up being $21,700 in this case. If the unadjusted balance were a debit, we wouldn't care. We were going to use this $17,400 that we've computed as the amount of the adjustment. That is the percent of sales method. The next one is the percent of receivables method, assuming that we have a credit balance of $4,300, and we've determined that 10% of accounts receivable are going to be uncollectible. That is $18,000. That tells us that the balance after the adjustment needs to be $18,000, and so I have to come up with the amount of the adjustment. So in this case, all I have to do is add $13,700 to the $4,300, and I've got $18,000. That's my adjustment using the percentage of receivables method. All right. Now we're going to go back and do the same things with a debit balance and allowance for doubtful accounts of $410, and bad debts are 0.75% of sales. This little number out here is the decimal representation of 0.75%, 0.0075. If you have 0.75%, you always take the decimal place and move it two places to the left to produce the decimal representation of a percentage. So 0.75 becomes 0.0075. All right. It's set 0.75% of sales. So 0.0075 times 1,740,000 gives me an adjustment of $13,050. You notice I didn't care about this 410 up here. I don't care if it's a debit or a credit. I'm just going to calculate the adjustment amount, and that's what I'm going to put in there. However, if we're going to use 6% of accounts receivable, then I have to come up with an ending balance. 6% of $180,000 is $10,800. So that gives me my balance, my adjusted balance. And I'm going to back in or figure out what my adjustment needs to be. So a $410 debit balance before the adjustment, I need to do a credit entry of $11,210 to make my adjusted balance equal what I have estimated as uncollectible. And finally, one more problem. The rich company has accounts receivable of $110,000 at March 31st. Credit terms are 210 and 30. Allowance for doubtful accounts has a credit balance of $2,100 prior to the adjustment, and we use the percentage of receivables method. Here is the aging schedule. This part here in yellow now was given to us from the instructions, and we just created this other column. 1 to 30 days would be 62,000 times 2%, 1,240, 18,000 times 5% is 900, etc. On down to 13,740. That is the balance in my allowance for doubtful accounts after the adjustment. So here's the entry, and here's the T account. We had a credit balance unadjusted of 2,100. We wanted a credit balance after the adjustment of 13,740. That gives me an adjusting entry amount of 11,640, and that would be my adjusting entry for bad debt expense, 11,640. Very good. Y'all need to be practicing these entries as much as you can to get ready for the quiz. It'll take some confidence and some proficiency in these to make that happen.